It's all about China with this business. And with the stock trading down over 5% today, the lingering fears around China are seemingly becoming reality. This is despite a fairly strong earnings report and even guidance slightly ahead of what Wall Street wanted. Trade restrictions loom over applied materials, and tariffs are creating a volatility in the market. Is this a short-term blip for this vital chip equipment provider or something more serious long-term? Welcome to The Quality Investor. A slight miss on revenue this quarter for Applied Materials, but the real reason for the market decline is fears over China. More to the point, a steep decline in China's sales seems to be the reason for the sell-off today. China has been an instrumental part of Applied Materials business over the years, so any decline in this geographic segment is cause for alarm to investors. In Q1 of this fiscal year, China sales accounted for 31% of AMAT's total sales. This quarter, it is down even further to 25% of total sales. So far through 2 quarters, China has accounted for just 28% of total sales. This is down from 37% of total sales in fiscal year 2024 through 2 quarters. Has this downward trend fundamentally hurt Applied Materials long term? Well, let's see. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Despite Chinese weakness, Applied Materials revenue is up 6.8% year to date. To make up for this weakness, Applied Materials has increased sales to far more strategic partners of the United States. Taiwan has made up 22% of sales in fiscal year 2025, up from 12% last year, and Korea is now at 23%, up from 17% a year ago. To me, this demonstrates a business that can pivot in the face of geopolitical uncertainty and is a real strength. Taiwan and Korea make up 80% of chip foundry revenue in the world, and Applied Materials provides foundry equipment. Yet despite this, analysts on the earnings call were stuck on China. One head-shaking aspect of Wall Street is that once a narrative about a business is developed, it is nearly impossible to pivot off that narrative even when presented with new data. Applied Materials in China is one such narrative. Google and search is another. But while management indicated China's spending and investment is down due to trade restrictions, the main point was AI and how that multi-decade build-out is reshaping the semiconductor roadmap. The main weakness in China seems to be around Applied Global Services, the segment responsible for servicing and maintaining Applied Materials' installed base. It grew at only 2% year over year. Much of the installed base is in China, and trade restrictions had an impact there. With new sales moving away from China, CFO Bryce Hill noted that they still expect low double-digit growth here in the long term. Remember, 90% of AGS revenue is recurring, and 66% of it comes from subscription agreements. The other themes that emerged on the earnings call are that Applied Materials holds a strong market position in AI-driven semiconductor systems, which is accelerating, and that tariff impact was minimal due to flexible manufacturing and supply chain adjustments. This again underscores the strength of Applied Materials to shift away from its supposed China reliance to support future growth. But the real question remains, does this earnings report alter the DCF for Applied Materials? In other words, is this stock a buy right now? Applied Materials closed the day at $165.57. You can see it dropped off sharply first thing in the morning when trading open and essentially remained flat the rest of the day. This has rendered Applied Materials essentially flat on the year, well, up 1%, but it has been recovering nicely since the tariff debacle in early April, only to fall over 5% today. But were these bad results in this earnings release? The revenue for the quarter is at $7.1 billion, which was up 7%. But more importantly, both gross and operating margins expanded. We have a gross margin of 49.1% compared to 47.4% a year ago, and an operating margin of 30.5% compared to 28.8% 1 year ago. This is signaling strong recovery for Applied Materials coming out of that semiconductor cycle trough that we've been in the last year to 2 years. Operating margins especially had been under 30% the last 2 fiscal years, and in both quarters of fiscal year 2025, they've been above 30%. So despite that Chinese market slowdown, Applied Materials is still figuring out a way to improve their operations and shifting operations to new customer bases. I quickly want to point out the operations of the 2 largest segments for Applied Materials. Their largest segment, Semiconductor Systems, grew 7.2% to $5.2 billion in revenue for this quarter. But they also expanded their margin here as well, at 36.2%, up from 34.7% a year ago. Now, the AGS, or Applied Global Services, did only have that 2% growth year over year. And remember, Applied Materials is forecasting long-term growth in AGS of low double digits. So a little bit of a slowdown in this quarter. But importantly, the operating margin was at 28.5%, which was the same as a year ago. So while they did slow down the growth there, and they had to move significantly away from China to obtain new sales, they're still maintaining the same level of operational efficiency. It's not increasing their overhead to do so. This net revenue by geography demonstrates the shift away from China and into Korea and Taiwan. You can see that 25% total sales Q2 of fiscal year 2025 compared to 43% last year. But look at the large bump for Taiwan, up to 28% compared to 15% last year, and Korea up to 22% compared to 15% last year. So while the China market has declined, Applied Materials is finding new markets, and not only new markets, but strategic allies to the US for their new markets. I quickly want to show the income statement just to point out the net income and the earnings per share. You can see the net income on a year-to-date basis is down from last year at $3.3 billion compared to $3.7 billion last year, as well as the earnings per share at $4.08, down from $4.47. But this is going to be a one-time event affecting Applied Materials. In the first quarter of this fiscal year, there is a remeasurement of deferred tax assets, the new tax agreement with Singapore. So going forward, we should see more earnings expansion. And we can see that in just this quarter for Q2, $2.1 billion in net income versus $1.7 billion 1 year ago. And another interesting thing to point out is the number of shares outstanding. On a diluted basis, it's 815 million, down from 837 million a year ago. In March, Applied Materials authorized a $10 billion share buyback program. And so far in fiscal year of 2025, they've already spent $3 billion of that. They've reduced their shares outstanding by 2.6%. And in my view, it is a good time to buy back shares given the price in the market. And I do want to point out the Q3 outlook. It's at $7.2 billion at the midpoint, which is slightly ahead of what Wall Street was expecting at $7.19 billion. But what they did increase was the range of the outlook, meaning instead of a plus minus here of 500, last quarter is a plus minus of 400. So they did expand that range, citing geopolitical uncertainty. And looking at the free cash flow, we can see that year to date, they are down for operating cash, $2.5 billion compared to $3.7 billion a year ago. A large part of that is we're starting from a smaller net income base due to that tax revision I mentioned, as well as an increase in the working capital. But capital expenditures are up in fiscal year 2025, nearly twice as much as the same time last year at $891 million. That means this year I am forecasting a fairly significant drop in free cash flow of around 37%. But is it a good time to buy Applied Materials? What assumptions am I using to get to my target buy price? I have total revenue growing by 5.7% on the bear case, 7% on the base, and 8.5% on the bull case. And if we look at the 2 largest segments, Semiconductor and Applied Global Services, for their base case, I have Semiconductor Systems growing at 7.4% and 8.5% on the bull, and Applied Global Services growing at 7.3% on the base case and at 10% on the bull case. I mean, very conservative. Now, you might see large revenue declines here in the display segment. However, display currently makes up 3% of the total revenue, and is a segment they're seemingly going away from anyways. But one thing that Applied Materials is really doing well is improving their operations. And if they continue to do so on the bear case, I expect the operating margin to grow to 32% by year 10, 33% for the base, and 34% for the bull case. And for free cash flow, like I mentioned before, I'm assuming a free cash flow conversion of 75 cents on the net income dollar in 2025, which would give us about a 37% decline this year. However, by year 10 for the bear case, I'm expecting that free cash flow conversion to be 85 cents, 90 cents on the base case, and 95 cents on the bull case. And just for context here, the average over the last 10 years for Applied Materials is 97 cents for free cash flow conversion, meaning for every dollar of net income, they convert 97 cents of that into free cash flow. And that would give us free cash flow margin of 22% for the bear, 24.7% for the base, and 27.5% for the bull case. Applied Materials closed today at $165.57. That gives them a PE ratio now of 20.1, which is slightly ahead of their 5 and 10-year average. Even their forward PE at 20.9 is also ahead of their 5 and 10-year averages. But given those growth assumptions I just laid out, we have a discounted cash flow price for the bear case at $186.12, for the base case $226.68, and for the bull case $280.09. The dividend discount is a little bit more generous, $202 for the bear, $242.58 for the base, and $296.62 for the bull case. They have a very good and growing dividend. For the base case, I'm estimating a 14.5% annual increase in that dividend. Their latest dividend increase, by the way, was at 24%, and their 10-year compounded growth rate for the dividend is now at 13.7%. This is a very healthy dividend. And for the exit multiple, they're at $220.71. So based on these numbers, there's still quite a bit of upside. The risk here is, do you believe China will be a long-term issue? And can they get back to double-digit growth for the Applied Global Services? Me personally, I think China's not going to be too much of an issue. As we can see, Applied Materials is shifting away from them. And I'm very confident that they'll continue back towards double-digit growth in that segment. So with no margin of safety, you have a buy price of $231.64, and with a 20% margin of safety for Applied Materials, it is a buy price of $185.31. A forward PE of 23.4. So right now at $165.57, I think it's a very good buy. And for me, it's been a buy for a while. I've been adding to my Applied Materials position throughout 2025. They have been significantly affected by the tariff volatility, and I feel like it's been a very good time to add more for this business because of that. I think Applied Materials will continue to execute on their growth plans throughout the rest of 2025, and that future growth is not going to be an issue for this stock. They're a very well-managed business, as evidenced by their very high ROIC, and Applied Materials is going to benefit greatly from the AI revolution as they are manufacturing the chip equipment to produce the semiconductors required for AI to even work.
Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.